Hi everyone, I am Susie Lyon with Hello Switzerland to talk to you today about insurance, specifically for those of us like me who have settled into Switzerland and may need an update on how to best look after our insurance needs. If you've been living in Switzerland for some time, you probably already have some idea and some experience with the Swiss social security system, also called three-pillar system, or at least you have some familiarity around it. You know you have several options, and it's a good practice to review your insurance setup, optimize your costs, and save money on a regular basis. So to give us that insight into the insurance system here in Switzerland, we will be chatting today to Marcus from Helvetia, who has extensive experience in helping settled expats set up or optimize their insurance needs. Firstly, let's meet Marcus and hear a little bit about him. Hi, Marcus.
Yeah. Hi, Susie. Hi, everybody. Thanks for having me on this interview. I'm glad to provide you some information. I've been myself an expat for about 10 years in the UK. I lived in London. And at that time, it was not easy for me to settle in, to understand the various insurance options. The National Health Service was very complicated. On the website, there was various information. It was not very clear to me. So I completely understand the challenges that people face when they're coming here to Switzerland. I've been working for Helvetia for about 7 years now, heading the expat services with about 30 consultants. They're based all over Switzerland, all the regions. They've got a very good command of English language. They speak obviously also other languages like French, German, Italian, and especially know the needs of international professionals that are coming to Switzerland or have been living here for quite a while.
Awesome. And you speak Italian too, because you're from Italy.
Exactly. Yeah.
So we're actually going to cover many aspects when it comes to insurance, such as the Swiss social security and health insurance. It's actually quite a lot to cover and it can be confusing, but we will go through the different areas of insurance one by one. So let's talk about the Swiss health insurance system, how it works, what you can expect, and what's mandatory to what to consider when choosing a health insurance company. So let's start with that. What is mandatory health insurance?
So you've got a basic mandatory insurance called KVG Lamal, which is compulsory for everybody that lives in Switzerland, family members, the children. And it's when somebody moves into Switzerland, you've got 3 months time to apply for one of them. The mandatory basic health insurance provides a basic health insurance cover for outpatient as well as hospital care. It's a very pretty good cover that you have, but if somebody has got a medium to high level health situation, then it might be not always the best cover. So you might need additional health insurance. The basic health insurance provides the way how you approach a doctor. So you have got the general practitioner model like you've got in the UK or other countries. You've got a telemedicine model where you have to call the doctor and after you go to visit your GP. You've got an HMO, which is health center with more than one doctor. Usually they're in the center of the cities. You've got also the cost sharing options. In Switzerland, you can choose for adults between 300 and 2,500 Swiss francs deductible. This is the amount of money that you have to pay before the insurance kicks in, the supplementary insurance. The higher the deductible, the lower the monthly premium that you pay. After this deductible, there is a cost sharing. You pay 10% of each bill, outpatient as well as hospital, maximum 700 Swiss francs. So having let's say a deductible of 2,500 Swiss francs plus the 700, you've got a yearly expenditure about 3,200 Swiss francs. But as I'm going to mention eventually later, it's always good to have a supplementary cover.
This is the basic insurance is the kind of thing that covers, if you have an accident or something like that, correct?
Exactly. Yeah, it covers health situation as well as accident if you don't work. If you work, then the accident is covered 100% by your employer. Right. But you have to work more than 8 hours a week, then it's covered for accidents at work and also outside work.
Okay.
If you don't work, then the accident insurance can be covered in this policy, in the health insurance policy.
So even the basic insurance is quite layered and quite detailed.
Exactly. Absolutely.
What if, you know, somebody wants more than that though, than the basic package? What kind of further insurances are available?
You've got supplementary insurance covers that covers from dental insurance for children, especially. For adults is not usually advisable, you know, because what you pay for the premium is break even at the end of the year, so it's not advisable. But for children makes it's a good choice. You know, the orthodontics, which is quite expensive, covers that. Then the gym memberships, or if you do various kind of sports like yoga, playing tennis, certain insurance companies in the additional supplementary insurance, they cover all of these kind of covers. And as well, if you want to have a semi-private or private cover in hospital, the the mandatory KVG does not cover that. You've got general award. So it's for that, you don't have choice of doctor. With semi-private and private, you've got free choice of doctors. With the private is worldwide and semi-private is in Switzerland. And then with the private, you've got the choice to have a single bed, you know, in the room. Semi-private is 2 beds per room.
It's a lot to consider, especially if you're feeling quite healthy. And then you have to think about, am I going to want a private bed or not if I end up in hospital?
Absolutely. You can always upgrade when there is a case that you need to go to the hospital, but then it gets expensive. You've got a basic health insurance. So it's advisable, especially, you know, over an age of 40, to have also supplementary insurance. Once you have a supplementary insurance, an insurance company cannot, if later you have a more severe, let's say, health situation, a health insurance cannot kick you out of it.
Right.
If you want to add it on later, and then you've got a health insurance situation, medical history, then the health insurance might not include that kind of medical situation, or cannot include you whatsoever with the supplementary covers.
Right. So there are obviously things that you have to consider when taking out the insurance and what kind that you take out. Do you have any other examples of what you have to consider when thinking about the insurance?
Well, very important is to have also the outpatient covers. You know, there are various outpatient covers, not only hospital, which covers also the medical expenses, because not all medicine is covered by the basic health insurance. You know, there's some expensive medicines that are sometimes co-paid by the basic health insurance, but the supplementary will cover medicine that you might to take in case you're ill, you know, that are not covered, taken care of from the basic health insurance. And insurance, the principle of insurance, any insurance, is in case the worst case scenario happens. You know, what we get sometimes is that some of our clients say, we don't go to the doctor often, we don't need it, you know, but it's not about that. It's about if, you know, something bad happens, then you're right cover. Because if not, it can be quite stressful, can be a stressful situation.
Yeah, and from personal experience, my 3rd year in Switzerland, I, for the first time, hit that deductible and went way over it. Obviously, I didn't have to pay any further after that, but it was one of those situations where previously I would have said, oh, I'm never sick and I'm okay and I don't need all those extra things. But it was lucky in the end that I had it, because you never really know what's going to happen. So lots and lots of things to consider with the extra insurances, the supplementary insurance.
Yeah, and it's not a big cost to have these supplementary covers, you know. We're talking about between 50 and 100, 150 more per month that you pay, but then you've got a really worry-free package kind of thing.
Yeah, great. So there's obviously a lot to cover when it comes to health insurance, but I think that's given us a little bit of an insight into it. So there is another part of insurance, is the social security system. And as a long-term resident of Switzerland, it's really the only part of the insurance system that I still haven't really got my head around. I understand some of it, but not all of it. And that's the Swiss social system, Swiss social security system. So let's get some insight into that. Tell us a little bit about what the Swiss social security system is.
So the Swiss social security system is called also the 3-pillar system. 3 pillars is like a house which is solid, on solid ground. You need three pillars to keep the house solid. The first pillar is the AV, EV, the disability, old age and survival insurance. It's called, is a state cover. Second one is occupational benefits. So if somebody works, they need to have a certain threshold. It's around 21,000 Swiss francs or more, then it's compulsory. And then the third one is private. So to cover any gaps of the first and second. Very important are the topics which are covered. The main topics covered by all three is the old age savings. So when you go into pension, the second topic is in case of survival or death, if somebody is passing away, that the partner, surviving spouse is covered. And the third one is disability. If a disability is happening, you cannot work properly, depending on the disability degree that you have, that you get a certain disability pension, which is either for a certain period of time, can be a couple of years until you can work again, or it can be lifelong disability. And these pensions are paid basically worldwide.
And one of these is great for savings, is that right?
Yes, I mean, you save in the first pillar and in the second pillar. In the first pillar, you save is deductible. It's a fixed deductible from your salary. Everybody pays into a pot that is paid to people that currently are old age, in pension, that are disabled, or survival benefits. And then once, if let's say you are 10 years in Switzerland, then you move to Australia, to the UK, to another country, then you can apply for these savings, and they will be paid out to you abroad. There are specific regulations because depending on the international treaties, sometimes it's paid in abroad and sometimes it's not paid abroad.
Right.
In the second pillar, you got the various plans by a company that you're working for, like the minimum plan, or you got a plan is more higher, you can saving more, which you can choose. But you cannot choose how you invest the money. This is the company that chooses the pension plans for you, and then you have to opt for one of these options. The third one, coming back to your question, is the ideal pillar to save money. You can deduct from the tax. This is the famous 3A and 3B. The 3A is fixed, it's around 6,800 Swiss francs per year, which you can deduct from the tax if you're working. But then when you pay it out, then is a certain reduced tax you have to pay. The 3B you cannot deduct from the tax, but you can invest in the same portfolio, the same funds. But then when you pay it out, then there is no tax applicable. And this 3B is basically the 3A, if the person is passing away, is by law exactly, it goes to the spouse, then to the children and so forth. You cannot change who gets the money when you pass away. The 3B, you can say, for instance, 50% my wife or my partner, and the other 50% my brother or somebody else. So 3B is much more flexible. Also, you can save 10, 20,000 a year, as much as you want.
Wow. Okay. So lots and lots of information about those pillars. And I think a lot of people who live in Switzerland, they know a little bit about it, but there's obviously still a lot of information and a lot to learn. You seem to be a bit of an expert on that. So absolutely. I do have
I try to make it very simple and not go too much very details, because if not, it gets too much information.
Yeah, absolutely.
It gets confusing.
So something that for me is like an expat tale as old as time is the old traveling, the old trailing spouse, or stay-at-home parent who comes to Switzerland with their partner. Their partner, is working and perhaps they're not working. So how is this person affected by these pillars, especially when they don't have an income themselves?
Absolutely. So in terms of if the other partner is working and the other partner would pass away, the first and second pillar will pay certain survival pension to this person, to the surviving spouse. So it's covered by the first and second pillar of the person that works. In terms of savings, the spouse that is working is deducted the AV, the first pillar from his salary, and also is saving for the spouse that is not working automatically. Right. But it's not enough. So it means if, let's say, the wife or the partner, the husband comes and they don't work for a longer period of time, it's advisable to do a 3B pillar. They cannot do a 3A because they're not working, but they can, let's say the partner can put some funds on a monthly, on a yearly basis for the partner, also for the children saving in a 3B fund. So it's saving for the partner. If the spouse doesn't work for a shorter period, a year or whatever, then and then it starts to work, and it's a different thing. Then they eventually cannot wait. They don't have to put a 3B, but when they start to work, they can start with a 3A and save. But it's very important because if a partner doesn't work for multiple years, they also have a gap later, in their pension. So it's important that at least they start with a 3B.
And if you are a person that doesn't work and so you decide to have a 3B, and then you do work, can you keep your 3B or?
Yeah, you can keep your 3B, absolutely. There are also certain products that you can switch the funds from 3B to a 3A. You can keep and continue the 3B. You can reduce the payments in a 3B and then fully optimize the 6,800 in a 3A. So there are various options, but there has to be always be careful about the products, because not all 3B products can be switched in a 3A.
Right. So it's important to know what you've got.
Exactly. And also there is a difference between savings in the bank and insurance. There is no big differences. If somebody stays for a short period, 1-2 years, then you do a 3A bank account, and then you don't lose any money when you're moving out, because the money is invested on a short term, and then you don't lose any money. If you stay long term, eventually it's more advisable to do it with an insurance company. You can be also split that, you can do 3,000 and 3,000 and 3A with a bank and with an insurance. You can also split that. The main differences is that you've got, if you save the money with an insurance and something happens to you with regards to disability, you've got a premium waiver. It means the insurance continues to pay the 6,800 lifelong.
Wow.
With the bank, you don't have that. In the bank, if you save 3 years and then something happens to you, what you saved. You got the interest on that. But with the insurance, you get the whatever the money you paid, the insurance continues to pay until the end of the contractual terms. So,
let's touch briefly on if you are in a relationship where you're unmarried, or perhaps a same-sex relationship. How does it differ for those people?
So same-sex relationship is very important. That has to be registered with the commune, with the town hall where you're living. If not, it's not applicable. And it's the same situation as if you will be married. So it's exactly the same as you're married, but it has to be registered.
Right. If
you don't register, it's not the case. If you're an unmarried partner, obviously, and let's say the person that works is passing away, first pillar does not pay to the surviving spouse. Right. Depends if there are children, if they're not children, there are various things, In the pension fund, in the second pillar, it has to be also depending what kind of pension system. Sometimes they pay, sometimes you can opt. So it can be complicated there.
Okay. So something that I've heard about when discussing buying a property is using that aforementioned pension as collateral for your mortgage. This is a foreign concept for most people. Can you give us some information on how this works?
Yes. The Swiss government gives the opportunity, if somebody is buying property, that you live in. So it's very important. It's not a chalet that you buy somewhere or an investment property. It has to be in Switzerland. It has to be, you have to live in. It cannot be abroad. It's basically, the concept is 80% is the mortgage and 20% is you have to bring money in. Out of this 20%, 10% can be cash, money that you're going to bank account, let's put it this way, or 3A funds that you have already saved. And the other 10% maximum can be from your second pillar. In German, it's called WEF, the Wohneigentumsförderung. It gives you the option to, and it's written on your statement, of your pension statement, how much money every year, you can use to put into this 10% maximum to buy property. Very important is that obviously if you're using money from the second pillar, then the old age pension, you know, what you're going to get is going to be lowered. You know, so you have to increase the investment in a 3A or in a 3B, so forth. So you've got a gap there. But this information, how much you will get, is written on the statement, on your pension statement. It's very important also the money that you're using there out of, you know, you cannot suddenly repay it into the pension scheme and stuff like that. So you cannot say, okay, you take 20,000, 30,000 out of your pension scheme to put it in buying a house. And then 1 year later, you close the gap by paying this 20 or 30K again into the pension scheme. So the pension scheme is not as flexible.
Right.
So it has to be carefully planned.
Yeah, so very interesting way in helping getting a mortgage there. I don't know if it's a unique situation just to Switzerland, but it certainly is interesting that you can use your pension for that. So we have discussed really many types of insurances, and we do have now some clarity around what's needed, what's mandatory, and what's optimal. And what's optional. But Helvetia actually provides a service that can help determine what you need, identify those gaps that we mentioned. You know, you mentioned about there being gaps in your insurances, and also help identify where you might be spending unnecessary money on insurances that you maybe already have or you don't need. Exactly. So tell us a little bit about this service that Helvetia offers.
So we've got, like I mentioned before, we've got around 30 consultants that are with a specific expertise providing to international professionals. The services include obviously all the usual insurances like household private liability, you know, the car insurance, you know, but also about pension planning, you know, gap analysis, the situation of old age disability, or if somebody's passing away. By having various information, like from the first pillar, the pension statement, it's enough for us to make a clear view about, you know, what is the situation in case all of these scenarios would happen to somebody. And then depending on their needs, you know, are they moving back to going to abroad, or they're staying long-term in Switzerland, they can assess, and then we can help them to fill in the gaps that they need to. We help with also property financing, you know, from the various pillars. The insurance portfolio review we help to save money. So there might be some insurance you don't need it, or you have two kinds of insurances. You know, it's very important every 2-3 years to review the current situation, especially when a life situation changes, like a couple gets children, you know, you have children, or you are buying property, or you're changing job, or you're creating your own company. These are signs or a life situation that you should understand. Okay, you need to seek professional advice, you know, to understand how to move forward. And then during your journey, you know, every 2-3 years, you can always adjust certain covers, take them away, optimize currently. But they're very important, especially if you're coming from abroad. After 30, 35 or 40 years of age, you've got lots of gaps in the various scenarios, you know, so it has to be assessed.
It sounds like they've got everything at Helvetia except a crystal ball to tell us whether we're going to need to end up in hospital or any of those situations. Excellent.
Absolutely. We can help also in providing a insurance portfolio review.
Okay, great. That is great. So thank you, Marcus, for providing this information to us. So for more information on Helvetia, you can visit them at helvetia.ch. And also don't forget to visit helloswitzerland.ch for all your expat needs. Their platform offers everything that you need to plan your move, make the most of your stay while you live and work in Switzerland.
Perfect. And also my information is going to be available on the Hello Switzerland website, my email. So feel free to contact me. Thank you very much.
Great. Thank you so much. I'm Susie Lyon for Hello Switzerland. This is Marcus. Thank you and goodbye.
Goodbye, everybody.